Welcome to a Strategic Treasure eBook recording. You are listening to Accurate Cash Forecasting, Challenges and Solutions for Treasury. This is an ebook underwritten by Treasury and written and produced by Strategic Treasure. This is being read by Craig Jeffrey, who's the managing partner of Strategic Treasure. The contents of this ebook include 5 sections: an introduction to forecasting, key challenges to forecasting accurately, strengthening the forecast, improving your results beyond forecasting, evaluating your next steps in forecasting. Section 1, Introduction to Forecasting. This section includes 4 parts: the purpose of forecasting, enabling preparation to forecasting, common forecasting types, understanding the differences, and Treasury's role in capital planning and cash forecasting. The purpose. What does your future hold? The art of prognostication can be useful in a variety of personal and professional ways, some more critical than others. Consider the following 5 scenarios. 1. Knowing what the weather will be like can help you plan a weekend schedule or decide whether to carry an umbrella. 2. As the manager of an ice cream store, knowing that an unseasonably warm day is expected during school holidays may impact your staffing decisions. 3. Your child is doing well enough in high school to qualify for an expensive private institution, but a scholarship is still out of reach. Knowing the school in question is an affordable $60,000 means you have 2 years to buttress your college savings or find another source of capital to fund your child's educational aspirations. 4. Your company is expanding in several new markets next year. Plans relating to new plants and equipment, as well as the creation of a new sales and customer support organization, will all demand cash. The net effect, however, is expected to last 9 months, according to the head of sales, and 16 months based on your projections. Your model shows the requirement of an additional €3 million. 5. Next year, your sales are expected to grow disproportionately in a region with an average DSO of 95 days, 60 days beyond the overall company average. The additional cash required to support this growth will need to be reflected in the working capital line you are currently renegotiating. Enabling preparation. Forecasting, or rather accurate forecasting, is important because it helps us prepare for different situations. From optimizing staffing levels and enabling retirement planning to understanding working capital needs and preparing longer-term balance sheets, forecasting enables a state of active readiness. If things don't seem to be heading in the right direction, we can act earlier. Equally important, forecasting can help us take anticipatory advantage of an emerging situation and provide sufficient notice to address an insolvency issue. It can also be used as a long-term planning tool for credit needs or to help others understand the relationship between activities and cash flow or capital demands. Common forecasting types. Understanding the differences. Most people in the financial roles will be exposed to 3 common types of forecast in their careers, each of which has its own focus, duration, and purpose. 1. FP&A, income statement forecasting. The financial planning and analysis, FP&A forecast, typically has a time horizon of 3 to 5 years, focusing primarily on income, with monthly or quarterly time buckets. This forecast helps answer the question, what do we think we will earn in the future? As such, it tends not to make a significant distinction between leasing and purchasing, since the accounting treatment for expenses may prove to be relatively close between the two from an income statement perspective. The difference in actual cash flow between a large capital purchase and making lease payments will be significant. 2. Short-term cash forecasting, a focus on the balance sheet. Some organizations are so flush with cash that they rarely expend any effort on cash forecasting in the short term. However, they are the exception. For most companies, short-term forecasting is an important tool. It may extend out as long as a year, or may only look forward a single month. These forecasts typically include the daily breakdown for at least a week or two, and may then be grouped by larger increments as one's view on the time horizon extends. The focus is on cash that can be used, not GAAP cash, but funds available in the banking system. Organizations running tight on liquidity tend to be masters of managing their short-term forecast. 3. Capital planning, balance sheet forecasting. Treasurers who understand organizational objectives and determine the type of balance sheet required to support them will typically engage in capital planning over a 2 to 3 year horizon. A quarterly time bucket is detailed enough for these purposes. Treasurers will share what the forecast looks like with their bankers and communicate what is needed to support the new balance sheet with other senior executives. Treasury's role in capital planning and cash forecasting. Treasury is responsible for capital and liquidity planning, as well as for the short-term forecast. Core to the Treasurer's role is ensuring the organization has adequate liquidity at a reasonable rate over both short and long time domains. Consequently, the Treasurer's responsibilities include protecting the organization's liquid assets and providing adequate liquidity. Section 2. Key challenges to forecasting accurately. This section is made up of 2 parts, data and process. Data highlights 2 challenges, and process highlights 3 of the challenges to forecasting accurately. The responsibility of ensuring adequate liquidity comes with a number of key challenges, from understanding an organization's cash flows to gathering the data needed for a forecast. The first part, data. Challenge number 1 is understanding the organizational cash flows and how they change over time. Anyone seeking to create an accurate cash flow forecast must first properly understand the organizational cash flows across several relevant time dimensions. Here are some of the aspects to be considered. How many different businesses does your organization have? Which ones are similar in their cash flow, and which ones have different characteristics and timing? One line of business may collect on the 5th and 25th of the month and offer terms that drive payment towards those dates. Another may offer net 30 terms, with sales occurring evenly throughout the month. Alternatively, perhaps tax makes a large, urgent payment without communicating this to Treasury until it is due. 2. Is the business made up of many clients, vendors, or a relatively small number? When large number of payments or transactions are involved, these are more easily modeled with a Treasury Management System, or TMS, or by using statistical functions. Larger and more significant transactions may often lead an organization toward detailed tracking by vendors or customers. Good communication with credit, for example, can help increase the accuracy of a forecast when working closely with customers. 3. What is material for your business? Focusing on larger flows is obvious. Monitoring minor flows that are quickly changing or approaching a material threshold allows forecasting analysis to occur where it matters most. 4. What is changing and what is largely static? A mature or slowly changing line of business is the easiest to forecast. Significantly more attention needs to be paid to cash flows that are evolving. This attention comes in the form of monitoring and modeling. Change can come from various sources and impact the forecast in different ways. For example, distribution channels may be expanding rapidly, making the rolling average or weighted rolling average model fall significantly behind. This creates a large variance of underestimating cash flow. Then, when growth reverses, the model gyrates past equilibrium and consistently offers a too optimistic model, leaving the forecast overstating cash inflows. In another example, suppose 90% of the line of business revenue is coming from the U.S., with 10% from outside the country. Growth is focused in a European country offering similar terms, yet collection is taking 90 to 100 plus days. The extra days create a disproportionate working capital demand by a factor of 3. As sales expand in this region over the course of a year from 10 to 18%, the working capital demand grows by an average of 2% overall every month. Change can come from various sources and impact the forecast in different ways. Significantly more attention needs to be paid to cash flows that are evolving. Challenge number 2, gathering the right data for the right type of forecast. While it seems obvious that getting the right data for a forecast is essential, the important qualifier is that your needs will be determined by the method you select. Here are some guiding thoughts on gathering the right data and information. 1. Low volume, high impact. Large value items that are few in number lend themselves to a couple of data sources, including both humans and systems. Large tax payments or acquisitions tend to have the characteristics of one-off events, and many organizations have key individuals report these based upon a materiality threshold. Other high-impact payments have an earlier life within the financial system and are best reported electronically. For example, an investment maturity from a custody or investment platform. For CapEx-heavy firms, large capital expenses can often be tracked before they hit the AP cycle, even though they may require far more care in managing for timing differences. 2. High volume, low individual impact. Data from systems is usually the foundation of a good forecast when it comes to high-volume transactions. For highly consistent lines of business, some Treasury groups cheat the process by relying on historical information from the banking system, as that is easily sourced. Others will supplement their internally sourced data with feeds from AR or an administrative system so they can quickly identify changing trends that are either secular or may represent a seasonality shift. Section 2. Process. Challenge number 3. Managing the forecast data workflow process. This section will address a few points of the forecast process. First, we will look at getting core data into the forecast process efficiently and accurately. Second, we'll briefly examine the process of identifying required adjustments to the forecast. You will need to get core data for your forecast process from areas outside of Treasury, but getting that data in a timely manner can represent a significant challenge. The non-Treasury areas concerned are likely to be busy and focused on their own objectives. Be sure to secure their commitment to provide initial data or offer additional insight about independent variables that impact the forecast. This may require goal alignment. An important principle is to seek to understand the business and cash flow well before you start asking non-Treasury areas to schedule automated downloads. Understanding the flows will usually require the following. First, talking to smart people in the business who have detailed current understanding. 2. Modeling some of the data manually, for example using spreadsheets, and gaining additional insight over various time periods. 3. Clarifying the cause of any significant anomalous numbers. 4. Setting up the data feeds. Listen to the next section on involving shareholders in the ongoing process. Equally important is making sure data is both current and consistent so your model or forecast will function properly. This requires knowing and acting on a few facts. 1. If you don't understand when data is entered into systems or updated, your reliance on those feeds will give you painful and unnecessary surprises. 2. Consistency of data can be achieved at times by following a consistent process. If you have some validation points that identify potential discrepancies early, you may have a chance to recover. Challenge number 4. Selecting the right forecasting methods. The quest for certainty in forecasting outcomes can be the enemy of progress. Nate Silver. Pinning down the best forecasting methods for your needs requires more work, but it also increases the likelihood of success. Here are some questions to consider. 1. What category of flow are you forecasting? Are these operating flows? Operating flows include cash flows from normal business operations, for example, receipts and disbursements. Is it from investment activities? For firms like insurance companies, these flows tower over the other two. Is it capital flows? These include flows related to a firm's financing activity, such as capital contributions and long-term notes. For each of these flows, what are the most relevant characteristics? Are they one-off or recurring? Is there consistency or variability? Does it represent seasonality or business cycles? Is there a rapid change, or is it trending on a secular basis? If you remain undecided between two methods, you can model both and backtest them. With enough data, you may see which model performed best over time through various cycles and economic environments. You can then choose the most effective model for your forecasting needs. Challenge number 5, improving the forecasting model. Variance analysis can either have merit or be a near complete waste of time. When someone asks you to perform a variance analysis between the FP&A forecast, which is oriented to income, against the cash forecast, which is oriented to the assets, because they were quite different this year at year-end, you know and experience 4 things. 1, you'll do it if the CFO or CEO is asking for it. 2, the information you try to generate will be useless. 3, you'll identify a number of items and refer to float and the difference in accounting treatment for cash and available funds at the bank. 4, once enough time has passed and management's ability to continue focusing on this topic wanes, they will move on to murmuring about float and unavailable cash. The power of modern treasury management systems to perform variance analysis is a forecaster's best friend. It allows the forecaster to quickly compare a forecast to an actual over chosen time domains and identify any differences. The reasons for these disparities can be evaluated and understood. This knowledge provides a feedback loop for forecast improvements and gives you the ability to true up the forecast in the near term since something was received early or late. Update the forecast model based upon better or additional information. Some treasury management systems allow users to manage multiple forecasts at the same time. Thus, a real-time comparison of various models can be achieved. This enables forecasters to identify the strengths and shortcomings of each model, adapt to the results, retest the data, historically and on a real-time basis, and adopt the newly vetted program. Section 3. Strengthening the Forecast. Section 3 contains 3 parts: predictive analytics through regression analysis, artificial intelligence, and other value-added technologies. Forecasting is very difficult, especially when it involves the future. Yogi Berra. Predictive analytics through regression. Computer models are good at crunching a lot of data and performing a variety of calculations. Regression analysis is one method used for this type of comprehensive evaluation, and regardless of implementation, it requires 2 healthy key elements. 1. Data. Without data, what is the computer to do? Models can extrapolate, determine trends, and verify the relationship between the independent and dependent variables. The dependent variable may be what you are forecasting. For example, sales figures. Modeling the impact of discounts or rebates could be a key driver for changes in the sales figures. 2. Relationships. Understanding what an independent variable can do to your cash flow requires one to think through the direct and indirect relationships. The information gathered can then be modeled to help you explore these connections and better predict their impact. For example, expected temperature variation, changes in your distribution channels, stock market volatility, and housing starts can all impact demand and cash flow in different industries. Forecasting complex cash flows accurately relies on properly understanding the relationship among several variables. This may require a type of statistical modeling called regression analysis that helps forecasters ascertain the impact of predictive variables on the dependent variable, which is what you are forecasting. Artificial intelligence. Determining causation or mere correlation can be time-consuming. The promise of better tools to run through data without humans having to define everything, source and cleanse it, seems too good to be true. For those who hope to have a computer that continually searches a variety of sources to see if there is a fit, correlation, or causation, the future is now. With so much about AI to learn, however, most organizations still have an enormous forecasting benefit to gain by working through the fundamentals first. The value in using analysis is that it provides a range of responses along with an appropriate measure of confidence. Creating a model that provides exact numbers may seem precise. However, just because rolling a pair of dice provides an expected value of 7 does not mean you won't get a total between 2 and 12. Learning a likely range is helpful and far more useful when calculating expected cash flow. Knowing what your buffer should look like is important for safety's sake. Other value-adding techniques. Forecasts can be modeled using different assumptions and tools. Most of these methods can be quite effective in the right situation. The following techniques help describe those situations and are not necessarily considered mutually exclusive. 1. Time modeling. Understanding the organization's business and cash cycles is an essential part of forecasting. Time modeling involves evaluating cash flows based on historical activity captured by the associated time dimensions. These parameters include modeling by day of the month, day of the week, and week of the month. Several are often used in combination, such as week of the month followed by day of the week. 2. Time series decomposition. Useful for cash flow predictions with seasonality or trends, time series decomposition is a way of normalizing data with moving averages to cancel the noise caused by set highs and lows. Historical data can thereby be smoothed over a given period, enabling forecast creation based on deseasonalized data. 3. Running models and backtesting. Users can carry out scenario analysis and test their results against historical market conditions. This allows the prognosticator to gain some experience as to how the new model would have performed in the past, with real data as an immediate validation. 4. Automated and consistent variance analysis. In practice, many companies do not routinely track variances. Automating this function provides an opportunity for treasurers to understand any issues that may arise and decide whether forecasting model adjustments are needed. Section 4, Improving Your Results. Section 4 has 2 parts: key elements of a working capital council and supply chain financing. Key elements of a working capital council. An effective cash forecasting strategy requires more than just the right set of tools. It also demands near constant communication and collaboration with various departments whose operations have a direct impact on cash flows. While Treasury is considered the steward of working capital internally, there are a number of departments, including accounts payable, accounts receivable, procurement, finance, and sales, whose actions can substantially increase or reduce liquidity. Thus, for any forecasting initiative implemented by Treasury to be successful, there must be cross-departmental buy-in and collaboration. In order to foster this type of cooperation internally, one method is to form a working capital council, in other words, a committee spearheaded by Treasury that consists of representatives from all the departments with a stake in working capital: finance, accounting, procurement, sales, accounts payable, accounts receivable. Where forecasting is concerned, a working capital council can help Treasury communicate its requirements regarding the type, level, and frequency of data to support timely and accurate forecasts. While a minority of firms currently use this approach, there are signs that more are planning to follow suit. According to Strategic Treasurers' 2017 B2B Payments and Working Capital Management Strategies Survey, 17% of firms polled were already using a working capital council, with an additional 8% looking to form one within the next 2 years. What are these roles? Treasury. Treasury leads the Working Capital Council. Treasury is typically considered the owner of working capital internally, but needs buy-in from other departments in order to effectively optimize liquidity. Accounting. Accounting needs regular, timely reports of cash flow activity to update ledgers, perform reconciliations, and generate accurate financial statements. Accounts payable and accounts receivable. These departments have a direct responsibility over relationships with suppliers and vendors, as well as customers, and play a role in developing sales and credit promotions and payment terms. Procurement? Procurement is involved in the purchase of inventory and company supplies and regularly interacts with suppliers. Legal and tax. They ensure regulatory compliance and that these requirements are met. They can be associated with updating supplier payment terms. Supply chain financing. At its core, supply chain financing is all about optimizing liquidity or determining the best possible use for cash resources. Given the broad range of technologies, strategies, and processes that companies deploy across their supply chains, treasurers often find that optimizing workflows in this arena can go a long way toward achieving greater visibility and control over cash movements. This allows treasurers to optimize their forecasts as the time and amount of upcoming cash flows to vendors can be predicted with a greater degree of accuracy. To illustrate how supply chain financing can impact Treasury's forecast, consider this example. Suppose a corporate buyer operating with 100 suppliers globally pays each vendor 15 times per year, with an average of $3,000 per payment, a total annual cost of $4.5 million. While all 100 suppliers must get paid, the individual payment schedules and financing arrangements established with each vendor can be customized. These customizations could include making payments early in order to receive discounts, extending payment terms so that cash can be deployed in other business areas, or adopting e-invoicing and e-payment workflows to streamline vendor communication. When using an SCF portal to manage these processes, both buyer and supplier gain insight into the specific payment terms and adjustments being made in real time, meaning information related to upcoming cash flows can be confirmed. This is pivotal for Treasury when developing predictions, as it allows practitioners to reduce the variances in forecast actuals through enhanced transparency into upcoming transactions. Section 5. Evaluating your next steps in forecasting. This section identifies 5 ideas. Forecasting is one of the top priorities for most Treasury groups, and as we have heard, it absorbs a significant amount of time. The next step involves getting specific about plans and actions. Here are 5 ideas to help you on your journey. 1. Assess your forecasting health. What are other organizations doing? What is a leading practice? These are great questions. Benchmarking your forecasts, how accurate you are, and what methods you use, and how far into the future you forecast is a good start. This provides you and your organization with perspective and context. 2. Confirm the value of forecasting. By this, we mean determining the value of the cost of funds, improved accuracy, and effective cash conversion cycle management. The law of diminishing returns exists with forecasting accuracy. Organizations' tight-end cash flows know the value of a good forecast out of necessity. Understanding how your organization values or should value Forecasting improvements will help determine the level of effort you should be willing to expend. Will you base the value upon your short-term borrowings cost or your weighted average cost of capital? Will you use your investment earnings rate? How does management perceive the value of improved forecast? How do they react to significant variances on the negative side? Answering questions like these provides a starting point to help your organization properly value improved forecasts. 3. Determine initial prioritization. Inventory the major cash flows of the organization. Then estimate the impact that a more accurate forecast could make on those cash flows. Finally, where there is a distinction of importance, perhaps a line of business, country, or currency has greater uncertainty or need, overweight that area. This will be your initial prioritization list. 4. Calibrate by difficulty. From the prioritized list you just made, you will need to think through how much work it will take to improve the forecast. Will you need a feed of data? Will extensive modeling be required? Does an outside party need to provide their estimates? By layering in the level of difficulty or cost to improve that forecast, you can further calibrate your list of action areas. 5. Document and begin. Document your thinking and plans from those steps above. Identify what you are going to do and when. Be specific. Get buy-in from the right people. Gather the materials, data, and/or tools you need. Refresh yourself on your Treasury management system's forecasting capabilities. Move forward. Meet your target dates. Measure your progress and report on your success. Thank those who helped make a better forecast possible. Do you need help with cash forecasting? Talk to Treasury. For general information, email Treasury at marketing@gtreasury.com. About the firms. Treasury is a leading innovator of integrated SaaS treasury and risk management solutions for the digital treasurer. Developed using the latest technology, Treasury helps empower organizations on their path to strategic treasury by enabling total visibility into their cash, liquidity, payments, and financial risk management. With enterprise clients spanning North America, Europe, Middle East, Africa, and the Asia-Pacific region, Treasury is headquartered in Chicago, with offices in London, Manila, and Sydney, Australia. Treasury's integrated treasury management system not only keeps pace with today's rapidly evolving enterprises, it surfaces the critical relationships between cash management and risk management. In this way, your treasury management information becomes an invaluable driver of strategic business decisions. Strategic Treasurer. Strategic Treasurer provides consulting, research, and professional services for treasury management, security, technology, and compliance. Since 2004, corporate clients, banks, and fintech providers throughout the world have relied on their advisory services, which are backed by a deep awareness of current practices, plans, and perceptions through their annual surveys and decades of treasury experience. The mission of Strategic Treasurer is to elevate and enhance the practice of treasury by advising individual clients and informing the industry at large. Headquartered in Atlanta, with consultants also based out of Cleveland, Washington, D.C., and Denver, Colorado, Strategic Treasurer guides treasury and finance professionals through real-world, mission-critical issues that organizations face today. Thanks for listening.